What is your biggest financial concern? Are you being as intentional with your finances as you could be? How confident are you that you'll reach your financial goals? How will life's transitions impact your financial plan? Welcome to the Clarity and Confidence for Life podcast with Tom Fleishel, founder, president, and CEO of Fleishel Financial Associates. Discover how we can help business owners, successful families, and corporate executives achieve clarity and confidence for life while providing tailored financial solutions that eliminate complexity and free you up to focus on what really matters in life to you and your family. Now, on to the show.
Hello and welcome to Clarity and Confidence for Life with Tom Fleishel. Tom, how are you today?
Fantastic. Thank you.
All right. I'm excited. This is part two. So listeners, if you have not heard the first part of this podcast, in other words, the last episode, this is a two-parter, and really it had to be turned into a two-parter. We kind of made the decision on the fly because there's so much information. And what Tom is covering is 10 top tax tips for 2022. I think he made me say that just because that is a tongue twister, my friend. And then you add Tom in there and it's even another T. But I just want to recap the first 5 that you covered out of the 10 so that the listener can go back and listen to those. And those first 5 were, it's too late to do much now for 2021 except, so there's some really good pointers in there. So there are some things that you can still do for 2021. Then there's portfolio tax loss harvesting. He spoke about, he's talked about number 3, which is managed distributions. Number 4, he spoke about municipal bonds and really give an in-depth view of that. And then the last one we covered in the last podcast was managing capital gains. So if you haven't heard it, go back and listen to it. You don't have to listen to it before this one, but certainly don't miss those first 5. They go hand in hand with these next 5. So Tom, did I get everything right, or is there anything else you need to clarify?
I think those are all right. I just wanted to reiterate that for 2021, you still have time to make allowable IRA contributions up until April 15th. Mm-hmm. So definitely, if you want to do that, be talking with your advisor, be thinking about how you want to make those happen. And for small business owners, independent contractors, you can still set up a simplified employee pension plan. And so those are some great ideas for saving some taxes still for 2021. The other thing I just want to reiterate again is this year we've had a little bit of volatility in the market, and there may be some temporary tax loss harvesting that you can do to bank some losses into the future for this year. So while you have the opportunity, the market's starting to kick back up again, but it may be a timely opportunity for you to take advantage of some losses that you can bank for future. So just a couple of things to remind people.
All right, fantastic. So we're going to start with the last 5 out of this 10 today. What's the first one?
The first one is the Health Savings Account, or HSA. And these are just a very handy way to save for medical expenses and reduce your taxable income. Mm-hmm. So if you qualify, contributions can be made with pre-tax dollars, which is huge, and you can use an HSA account to pay for qualified medical expenses like x-ray and lab fees and things like that. Like I just used mine recently for an MRI that I had to have done. So it's a great way that you can use monies that are pre-tax. Not everybody qualifies to contribute to these, so you must enroll in what we call a qualified high-deductible health plan. Not everybody has those, so you want to make sure with your plan provider, that you're eligible for these plans. So there's certain contribution limits and withdrawal rules that apply, so you want to make sure that you're following all those rules.
Hey, Tom, I'm just not familiar with HSA versus, I think another one is called flex spending or flex account or something rather. But with an HSA, is it a use it or lose it type of scenario with an HSA?
Actually not. You can roll it over from year to year, and you never have to worry about losing your savings. So
nice. Okay.
You can just, if you don't use it all in one year, you can roll it over and it continues to grow and build. If you're over 65, though, enrolled in Medicare, you can't contribute to an HSA any longer, but you can still use the money for out-of-pocket medical expenses.
Yeah, I think...
You just can't contribute if you're enrolled in Medicare and 65.
Gotcha. Yeah, because whatever my wife and I have, we don't have an HSA, but whatever we have, I know that she's like, okay, we got to use this or else we lose it. And I think it's a terrible idea. So it sounds like an HSA is a much better option. So I'm gonna have to talk to her and look into see if maybe we have that option for the future. So that's great.
Yeah. Now HSAs have 3 distinct tax advantages. First off, HSA contributions are either pre-tax if it's through an employer,
okay,
or tax deductible if you opened your own. So you don't pay taxes on the account's growth. And if you make withdrawals for eligible expenses, you don't pay tax on those withdrawals either. So it's really got a lot of advantages. So let me give you an example. So the contributions don't count towards your tax burden. So for example, if you made $40,000 per year and you put in $3,000 in your HSA, you'll be taxed as though you made $37,000, thus lowering your tax burden.
As long as you're using the money from the HSA for qualified things, right?
Exactly. As long as they're for qualified medical expenses.
Gotcha.
And another benefit of HSAs is they can be invested in mutual funds, stocks, or other investment tools. And so different companies can help you do this depending on your investing preferences.
Mm-hmm. And I don't want to dive too deep into this. I'm not trying to get into the weeds, but when you say qualified things that you're paying for, from my understanding, you can also get some like just general medical items for your home, first aid kits, Band-Aids, alcohol, not like whiskey, but, rubbing alcohol or whatever, right? Things like that. Is that possible in an HSA? Do those qualify as like things that you can have at your house?
Correct. Yes.
Oh man, that's great. Yeah. Okay.
So they're a wonderful tool, another way to save taxes and put pre-tax dollars away. And if you qualify, definitely look into that.
Yeah, fantastic. All right. I know this sounds strange because we've only covered one, but what's number 7? Because, out of the 10, number 7.
Number 7 is if you can itemize deductions, it's getting more and more difficult because it's getting higher and higher. It's like $12,950 for a single person that you can have all these deductions as a standard deduction. But if everyone's married or filing separately, $25,900 for anyone who is married and filing jointly. So it's getting harder and harder unless you have a lot of mortgage interest, charitable contributions, or medical expenses. And there's some state and local income and sales and personal taxes that you can still qualify for up to $10,000. So if you do want to make, for example, larger charitable contributions and you have some medical expenses and you have taxes that you're paying, this is a great way to continue to defer and save on taxes. So let me give you an example. There was a client of ours that had a huge year that he had some major tax problems. He sold some property. He's had a higher income than he expected. And he actually made a contribution and front-loaded something called a donor-advised fund. So he needed some extra deductions. The way the donor-advised fund works is that you can make a contribution as much as you want in a given year. And then if you want to front-load it for like your charitable contributions for 3 years, you can just front-load it. And when they come out later, as the money grows tax-deferred, they can come out to those charities. But you can front-load something like this as a donor-advised fund and then use that contribution to help qualify for itemized deductions in a given year if you need to.
So what I'm hearing is that let's say, so the standard deduction for a couple is, I think you said $25,900, if I'm not mistaken.
Correct.
So if you normally, give $12,000 a year to your church, right? $1,000 a month, for your tithe or whatever, or you have another charity that you're supporting on a monthly basis. If you were to take 3 years of those expenses, so just doing that easy math, that's $36,000. If you were able to, you could put all that into this fund, and then how does it get distributed to your charity of choice?
The donor advised fund allows you the flexibility to designate which charities you want the money to go to. Once it's accumulated into the bucket, you decide later how it comes out and when it comes out. It's totally your discretion. As long as it's a qualified 501c3 organization, nonprofit, you can allow them to designate when and how you want the monies to go out. So it's totally flexible, and it can be invested in anything, again, like stocks and mutual funds and bonds, and let it grow. So you get the advantage of front-loading and qualifying for itemized deductions, letting the money grow, tax deductible or tax deferred, and then it comes out to the charity. So it's a really great tool.
Yeah, that's perfect. That sounds great. I'd love to hear more about that. I think we could have a podcast about those and kind of some of the strategies behind that.
Absolutely.
All right. I'll remind you later.
Okay.
Sometime in the future. Okay. So that's itemized tax deductions. What's number 8?
I love this one. This one is so cool, and a lot of people aren't aware of these. If you're over 72 and you have pre-tax qualified retirement accounts like IRAs, 401ks, and you know it's 72 now, they extended it from 70 and a half to 72, you have to start taking out what we call required minimum distributions.
Okay.
Those are a function of your age and the account value. So when you take that out, it's all taxable, and you have to take it out. The IRS mandates that you take out this required minimum distribution each year. And so otherwise, it's just going to be taxable income added to everything else that you have. So, we want to figure out a way that we could do this tax-free. So there's something called a qualified charitable distribution. And what this allows you to do is, again, designate a qualified charity. Any 501c3 will work. Your church, your community organization, anything that you'd like as long as it's a 501c3. And then it has to go directly to the charity. So there's specific forms that have to be filled out for that to happen. Otherwise, it won't be qualified and you'll be taxed. But it can go tax-free to this organization, and you don't pay tax on the money that comes out as you normally would.
So it doesn't count towards your income, is what you're saying, right?
Right. So if you're charitably inclined and you give to your church, community organization, any qualified 501c3, the money comes out and goes directly to them, and it's not added to your taxable income in that year.
Man, that is really, really smart. I mean, I know that with RMDs or required minimum distributions, the big word there is required, right? And I think there's penalties if you don't take your required minimum distributions when you're supposed to, correct?
Yes, it's a 50% penalty on the amount that you should have withdrawn. So you definitely want to pay attention to the fact that you've got to take this out each year. And if your financial institution provides this most due, they should give you the actual amount that you have to take out, and you shouldn't have to calculate that yourself. For our clients, it's automatically calculated, and we actually do it on a systematic basis every year. But if they do want to use the qualified charitable distribution, we factor that in. There's special form, so make sure you do it right.
Well, again, so let me ask you this. Can you split, I guess is the best way to say, can you split your required minimum distribution? So let's say that if a family is required to take out $20,000 from their account, and that's their RMD for that year, but they normally give $10,000 to charity per year. Can they do $10,000 in a qualified charitable distribution and then $10,000 in an RMD?
Absolutely. You can do any flexible way you want to. You can give it to 5 different charities if you want to. So
but it
there's
doesn't
a lot
have to
of
be the whole
flexibility.
amount.
Right.
Oh, that's perfect. Yeah, because I mean, even that little bit that you already plan to give away, that coming off your counting towards your income, that saves you taxes right there. Well,
absolutely. Sure does.
All right. What is the next thing we're talking about?
Well, for those that are still working, everybody's heard about the 401k, the 403b, all the different types of company-sponsored retirement plans, but it is the best way for employees to save taxes, especially coming up for this year. So if you're under 50, for 2022, you can defer up to $20,500 of your income. If you're over 50, you get a extra amount that it gets allowed to bring you up to $27,000. So what that does, again, is just reduces your taxable income. So if you're making $60,000 and you're over 50, $27,000 comes off the top and you're only taxed on the difference. So why would you not ever want to do that if you're really, in a high tax bracket in particular? Those are the things that are really, really a great way to save. And I want to stress to everybody that a lot of plans don't give you a lot of flexibility on your deferral options. So you want to start early this year. It's already into February. So if you're going to make those elections, don't wait. Go ahead and get that done right away. Hopefully you can get that set up so for the rest of the year, you're going to be able to defer what you're allowed to for 2022.
All right, that makes a lot of sense.
So again, for every dollar you contribute, it lowers your taxable income by that amount. And we just want to make sure we remind everybody to get those elections started this year. What happens over time is these can be built up as a family's largest asset. We've had clients come to us and, boy, we start asking questions, all of a sudden they've got a $500,000, $1 million 401k, and we start digging deeper. We find when it comes to selecting investments, they're just kind of winging it, guessing on the investment choices, like kind of throwing darts.
Yeah.
So you don't want to be that passive about one of your largest assets. So for that reason, we set up a customized service to help employees and corporate execs go in deep dive every quarter, analyze the best choices in their lineup, and make quarterly rebalancing recommendations, that are based on their goals and current market conditions. We started this program, for example, for a female VP in a large tech firm that over the last 15 years, she's grown her retirement accounts to the point where she can actually retire earlier than she ever dreamed.
Wow.
So it's huge, compounding over time, making those maximum contributions and making sure it's allocated and managed properly is really the ticket to getting you to where you want to be, and maybe sometime sooner than you ever thought.
Tom, where were you when I was younger, man? Seriously, I remember the first 401k I ever signed up for. I was, mid-20s, and the rep came and talked to us about, this is what we're doing, this is what we're starting, and, here are your choices, and it was just a bunch of mumbo jumbo that I didn't understand at that point. I'm like, I don't know, which plan to choose. He's like, you're young, choose the most aggressive one. Okay, why? He goes, you got time. Okay. That was the conversation, and it was check the box and then never think about it again. So
that's typical. Yeah, people check a box and forget about it, and markets change, your goals change, so it's something that needs to be reevaluated on a regular basis. It's been a very interesting couple of years, and so it's just important that people stay real proactive with this and stay focused on how these things should be managed, and hopefully you've got either if you've spent a lot of time to figure it out yourself, but most people don't do that. And so they're going to need somebody to help them really dig in deep, analyze all the different choices, because many times in the lineup, if they have, for example, 5, let's say, large cap U.S. stock fund options, 3 might be great, 2, one of those is okay and one's terrible. And if you're just kind of throwing darts, it could really impact your long-term return opportunities.
Yeah, absolutely. All right. Anything else with that, or are we moving on to number 10?
I think we are moving on to the last and best one for business owners, and I love this option. It's the best thing since sliced bread for business owners, because the opportunities that you have for business owner sponsored retirement plans, if you're a small business owner, there's all kinds of different options. And what the main goal is for you to be able to save taxes, also to diversify from your business. Too many times business owners banking on their entire retirement on the sale of their business, and they haven't built wealth aside from their business. So that's another huge benefit, is they can really build and diversify their wealth. And then to reward and help retain key employees. Let's face it, there's a lot of turnover going on right now, and small business owners really do need to have attractive retirement plans and other benefit packages that are going to retain their loyal employees. And so these are really a great way to do that. So too often, employers just kind of go with some kind of a boilerplate solution that are proposed, not really customized to their particular situation. We call that their census data, which means is what's the lineup of their employees, how long they've been there, what's their compensation. So based on a formula that can be customized to their particular business, we can get customized solutions that are designed to really maximize the contributions that can be made for the owners and the highly compensated. So and then it ends up being on a ratio that is surprising to a lot of business owners, that actually sometimes the numbers can come out to 90% to the owners and highly compensated when you make contributions, and 10 to 15% or so to the other employees. So they're still getting a benefit that they would not have had, but you're able to really load up on some huge tax savings and dollars that go in for the long term.
There's a lot more there, I'm sure. I mean, I'm sure this could be, again, an entire podcast. Man, I don't even know where to begin with questions.
Well, let me give you just a simple example of why this works. So suppose you're, in the 30% tax bracket, and you have $1 in earnings, and you take that dollar out and pay taxes, you're left with 70 cents. And suppose we can invest that and earn 10%. At the end of the year, you have 77 cents. Mm-hmm. But instead of taking it out and paying the tax, suppose you put it into one of these retirement plans. So guess what? You get to keep the 30 cents that would have gone to Uncle Sam. Now you start with $1. And if we can earn 10% on that, you're left with $1.10. Which would you rather have, $1.10 or 77 cents?
Yeah. Okay. I am that smart at least. $1.10.
So if you're the only owner and no employees, oh my gosh, there's unbelievable, opportunities here. But even if you do have employees, the numbers can be worked out so that really is still a huge advantage, because even if you make contributions for the employees, those are all tax deductible in your business. So not only are yours tax deductible, the ones that you make for employees are tax deductible. It grows tax deferred, and it's actually creditor proof, because retirement plans are creditor proof from the IRS. So again, some really nice opportunities. I just can't stand, not seeing people being able to take advantage of these. And many times they're just using a plan that's really too much of a standard plan that's really not customized to their situation.
Mm-hmm. Well, let me ask you this, because during COVID, I know that some of the research that came out of the first year of COVID, 2020, was that there was a lot of people that started home-based businesses. So there may be a lot of those single owner, only employee kind of situations, but some of them are just part-time businesses. Some of them are, maybe full-time businesses, but obviously the salary or the amount they bring in to their business varies. What are we looking at here for somebody who owns a small business? They're the sole proprietor and they're the only employee. How much do they need to be bringing in to make something like this worth it?
I would say, probably if their bottom line profit is ended up being in the 30 to 40 to 50,000, then it begins to make sense to use some of these. There's smaller options that we can use, like a simplified employee pension plan. But if you're getting up into the higher levels, you go into a 401k/profit sharing plan. There's even ones above that called cash balance, which are defined benefit plans. You can layer these things. You can use, a lot of them are so flexible that if you don't have a great year, you don't have to make a contribution. You're not really obligated. So they are quite flexible. And depending on their situation, their profit in any given year, that's definitely some opportunities that we don't want to miss out on.
All right. Well, you heard it, audience. If you know somebody who owns a small business, whether they have employees or don't have employees, but I think a lot of us know people who started their own little home-based business. This is great for them. Please share it. They're going to need to know this. Tom, anything else before we wrap up today's podcast?
I just want to reiterate the importance of all these different types of plans that we've talked about. Make sure you look into them. You don't want to pay any more tax than you're obligated to pay. So let's take advantage of every opportunity that's available to us.
All right. Sounds good. And then for those that do want to reach out and talk to you and maybe have some questions about any of the information you shared on this podcast or the last, what's the best way to get a hold of you?
They can call us at 386-738-1800. Or they can email us at fleishelfinancial@raymondjames.com.
All right. Perfect. Thank you, Tom, so much for your time today.
Thank you.
You bet. And of course, last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Clarity and Confidence for Life podcast with Tom Fleishel. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Tom comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. Again, thank you for listening today. For everyone at Fleishel Financial Associates, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Clarity and Confidence for Life podcast. Click the subscribe button to be notified of new episodes when they become available. The information covered and posted represents the views and opinions of the hosts and/or guests and does not necessarily represent the views or opinions of Raymond James. This content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional financial advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation. Securities are offered through Raymond James Financial Services Incorporated, member FINRA, and SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Fleishel Financial Associates is not a broker-dealer and is independent of Raymond James Financial Services.